Hey guys, Smarty here with another full knowledge check. Here's an extended version of a few key terms you should know. First is asset. An asset is anything of value or a resource that can be owned or controlled to produce future economic benefits. Assets can be tangible, like real estate, machinery or inventory, or intangible, such as intellectual property, patents, or brand value. Businesses and individuals use assets to generate income, improve financial stability, and support growth. Next is liability. A liability is a financial obligation or debt that an individual or business owes to another party, typically arising from borrowing money, services, or goods. Liabilities can include loans, accounts payable, mortgages, or any other financial responsibility that requires repayment over time. Managing liabilities is crucial for maintaining financial health and stability. Third is stocks. Stock represents ownership shares in a company, granting shareholders a claim on the company's assets and earnings. Stocks can be bought and sold on stock exchanges, and their value fluctuates based on the company's performance and market conditions. Investors purchase stock with the expectation of earning returns through dividends or capital appreciation. Next is index. An index is a statistical measure that tracks the performance of a group of assets, such as stocks, bonds, or commodities, to gauge the overall market or sector's performance. It is commonly used to represent the movement of a specific market segment or economy, with well-known examples like the S&P 500 or Dow Jones Industrial Average. Investors use indices to assess market trends and compare the performance of individual investments. Next is ETF. An ETF, exchange-traded fund, is an investment fund that holds a diversified portfolio of assets, such as stocks, bonds, or commodities, and is traded on stock exchanges. ETFs provide investors with a way to buy a broad range of assets in a single transaction, offering liquidity and lower costs compared to mutual funds. They allow for flexible trading throughout the day, similar to individual stocks. Next is bond. A bond is a debt security issued by corporations, municipalities, or governments to raise capital, where the issuer agrees to pay back the principal amount with interest over a specified period. Bonds are considered fixed-income investments because they provide regular interest payments, known as the coupon, to bondholders. Investors purchase bonds as a way to earn steady income while minimizing risk compared to stocks. Next is portfolio. A portfolio is a collection of investments such as stocks, bonds, real estate, or mutual funds held by an individual or institution. The purpose of a portfolio is to diversify risk and maximize returns based on the investor's financial goals and risk tolerance. Portfolios are regularly reviewed and adjusted to reflect changing market conditions or investment objectives. Last is dividends. A dividend is a payment made by a corporation to its shareholders, typically in the form of cash or additional shares, as a portion of its profits. Dividends are usually paid on a regular basis, such as quarterly, and provide investors with a steady income stream. Companies that pay dividends often distribute them to attract long-term investors and reward those holding shares. If you learned from this, be sure to follow, like, comment, and subscribe. See you next time.